Good morning, traders. John Caruso coming to you here for the morning of April 20th with your pre-market video for the session. Taking a look back at the S&P 500 yesterday, we did trade in an approximate 30-point range, down 9 points on the session, which is a rare occasion nowadays. Just to kind of put this entire move into context here for you, we have seen an approximate 400-point rally since the beginning of March, or 11% on the upside in stocks. What has kind of happened here is the Fed has the market in what they like to call Goldilocks, not too hot, not too cold. They've managed to keep the bond vigilantes at bay, stabilizing the rise in the 10-year yield. We did see the 10-year yield rise just before 2021 from about 90 basis points up to 178, where basically the bond vigilantes were in there forcing the bond prices lower, raising interest rates, and basically raising interest rates for the Fed. Because the bond market typically knows when we're going to be in an accelerated period of growth and inflation, which we certainly are right now in Q1 and Q2 in the first half of this year. So right now, the bond market, 10-year yields are stabilized right around 160. They've been trading in about a 10 basis point range for the last couple of weeks. So the bond market has stabilized, which has kind of given a green light to stock traders and commodity traders to continue to push the market higher over the last couple of weeks. Obviously, the rise in the 10-year yields and in interest rates was something that has been in the back of traders' minds for the past couple of months, and that's no longer obviously a problem at the moment. PPI, CPI, all the inflation data, retail sales, red hot numbers that we've seen come out in recent weeks. The earnings cycle, the bank earnings last week, red hot bank earnings with the rise in 10-year yields. Obviously, banks like to borrow from the Fed at the short end of the curve, raise to guys like you and I at the long end of the curve, and as long as the long end of the curve is pushing higher and there's a steeper yield curve, banks are making money, so that's good for the banks. We do have some tech earnings that are coming out here today. It's going to be a relatively light week in terms of the data. We do have the ECB on Thursday, so that could shake some macro markets up as well, depending on what they tell us. Taking a look at some of the ranges here today, we've got upside in the S&P 500, bullish trend, upside to 4206, downside to 4057. It's a widening range right now. Volatility is suppressed in that market, so you got to be careful when volatility spikes do happen, but they're likely just going to be buying opportunities, at least for the next few months, we think. Taking a look at the 10-year yield, we're trading in about a 175 to 156 basis point range. That's what we've got today. We see 156. We'll be shorting bonds. We see 175. We'll likely be taking profit. Taking a look at gold, not one of our favorite asset classes right now. Gold trading at 1738 with upside to 1791 in the range. Bearish trend. It's been bearish trend now for about between 3 to 6 months. We're always trading with the 3 to 6 month trend of the market. Right now, this recent rise in gold, we would call that bullish trade. However, the longer-term trend is bearish trend. Taking a look at oil, oil bullish trend, upside to 64.42, downside to just over 60.16 in the oil market. We're still bullish on energy. One of the markets that we're looking at right now, because we like the structure of the chart, just don't have some of the fundamental backing for it yet. Just quite yet, is natural gas. Keep an eye on natural gas prices as we move into the summertime. The U.S. dollar has been moving down basically in a straight line since the rally that we saw back in March. The U.S. dollar is now immediate term oversold. However, it is bearish trend, so you want to keep that in mind as well. That's all I have for you this session. Hopefully this was helpful. If you have any questions, feel free to reach out to me by email. Once again, I'm John Caruso. We'll see you next time. Take care.